On live. Hello, everybody. Welcome to TraderMerlin show. It is your, what are we on, Thursday? It's Thursday edition already. Love it. We got an eventful day today. My guest is joining me from Southern California. We have had him on many times in the past. I actually had the opportunity of working with him for several years at Online Trading Academy. Our topic today, though, is a little bit different. You see the graphic here. It says markets standing on the edge of the cliff. Our guest today is Mr. Mike McMahon. So welcome, Mike. How you been?
I'm doing well, Merlin, and Happy New Year to you.
Happy New Year. What's new in your world, my friend?
Not too much. For Christmas, I got a couple of ragdoll kittens that I'll take possession of next week. But otherwise than that, just trading and teaching.
All right. I'm wondering why my video, there it goes. Video looked weird. Trading and teaching. So tell me about that. What are you teaching? I don't get to see your schedule too much.
Well, I'm still working with Online Trading Academy as an mastermind community teacher and still hold my sessions. Been doing it now for 6 years.
Wow. And your mastermind is generally, what do you cover?
Oh, just everything. Deep dive into the markets, try to answer questions, try to get people straight on some of the minor basic things, like not losing.
Oh, the beauty of it's funny because you and I talked about this many years ago, probably going back into the late 90s, which was, so many people are focused on how much money they can make at this when the real challenge is how much money they can lose. And as soon as they focus on that, then things start to turn around for them. So it's hard to slap them around and make them realize that.
You're always dragging that horse to the water. Now, making him drink is another question. But, as I've always said, a good trader is not told by the quality of his wins, but by the quality of his losses.
Mm-hmm. Well, walk me through, I had the graphic up there, which was the market standing on the edge of a cliff. And, I think the reality, which my viewers know rather well, is, look, it doesn't mean that this thing is over. There's just things you're looking for. And you have been, you have your bullish and bearish phases for the market. So what are some of the things that you're looking at that make you go, yeah, things might be spinning?
Well, first off, I am optimistic. I think I'm long-term bullish. But the market is giving us a whole lot of signals. Some people would be, they're rather obvious. Here, let me share a screen here with you.
Yeah.
And let's see, there we go. And share. So I assume everybody can see some charts here.
Got you now. I'm missing my chat panel, so I'm trying to get my chat panel working over here. So as you go through this, I'm trying to get the chats back up.
Okay, well, we can handle it.
I'm sure we can.
Yes, hang on. There we go. Be a good chart. So one of the things I've been noticing recently is, of course, the very toppy nature. Right now, we're looking at the S&P 500 E-mini. And if I were to take it out onto a daily time frame, you can see that we were looking at some things earlier today, and it's pretty obvious. This is a Fibonacci projection of where it could go from a recent all-time high. And so simply I've drawn from a low to a high of a logical run, and then down to the next low, and let it project up. And what you can see here is perfectly 3 days ago that we dojied out right on the 76 point line, 76.4 line. Okay, so if you're a Fibonacci fan, that's telling you that we couldn't do anything for 5 or 6 days in here, low to high, and then of course yesterday and today we're dropping down. So what is this? Is this profit taking, or is it time for a correction? And that's the question. Now, most corrections take place between, call it 7 and 10%. So I just simply did the math on 4809, okay, which was the all-time high. And that brought us down to, you can see my demand zone there. That is a 10% drop.
Yep.
So take us all the way back down to about 43.30, 43.28. And so this is one of the first things I was looking at. So I'm sure you're seeing the same kind of things.
Mm-hmm.
Tell me your assets that you follow. Another one that I had a look at, and this takes me way back to my days in TAG. And TAG was the Technical Analysis Group of the United States before CMA was out, or CMA, Certified Market Analysis.
Yeah, something like that.
And if we look at this thing on a monthly, okay, here we have the COVID March 2020 here at the bottom, and just drew a simple trend line up. Okay. Anytime, one of the things that, well, I didn't really dive into the discipline of geometry for trading,
Yep.
chart geometry. One of the things I did remember from it was that 67 degrees is really hardly can be exceeded. So here I put in a 67 degree line. Let's make sure that is.
And while you do that, real quick, everyone, if you want to just hit refresh and your chat should be enabled. I'm not sure why it did that, but apparently I said that this show is for children, and if it's for children, you can't chat. Did not know that. So adults only today. Hit refresh on your browser and you'll be able to chat from there. Sorry about that.
So I drew a line over here that is a 67 degree bubble up. Okay.
Yep.
And you can see that it's pretty much parallel. And in fact, that line is just about dead parallel with what we have there. Now, to show you that this actually works, all I do is draw another line. Let's see if I can find that guy. And if we were to take it up to the last correction, okay, up through here.
That's right. The children are coming in. No, we've just booted the children out, everybody. That's what happened. I did not know that you had no chat enabled. Hey, Amy, good to see you. You doing trivia tonight? It's so nice to have the chat. It's weird, Mike. I've never had it with no chat, so it felt kind of foreign, and all of a sudden now we got chat back, so it's good. All right.
So anyhow, you can see what happened the last time, okay, that we exceeded 67 degrees up. We had a huge, this is a month now, remember, of drop. But it wasn't 10%. It was about 4 or 5%, okay? So this is another, what would you call it, weight on the balance beam here, okay? So we've got a Fibonacci indication, we've got that. And then, of course, you add in things like the 10-year note, okay? That they're up, the yield's up to about 173. In the summer, we got up to, in September, we got up to about 163, and the market corrected, okay? So with the talk from the Fed about, tapering and possible interest rate hikes sooner, I think the market's getting a little spooked.
I do as well. We've been talking about this for a while, and I haven't built the short position yet. I've been wanting to. I actually was really wanting to do it before the FOMC meeting minutes because I thought it would just shed a little light into what was actually going on there with Powell, his team, and kind of what was going on behind the scenes. And of course, we saw the reaction in the markets happen as those meeting minutes were released. But I'm in your camp, Mike, with that. I love your 67-degree parabolic move. I mean, you haven't really seen a move like that in the last 50 years, at least that sharp of an angle, and all of that being fueled not because the economy is doing great, not because jobs are great, not because America is great, but because we've pumped $17 trillion into the marketplace in an 18-month window of time. So, that to me is probably the biggest part of it. And the analogy I make all the time, which is probably a horrible analogy, is it's kind of like somebody who's hooked on drugs. They always say that the first high is the best high, and then the problem with an addict is they're always trying to replicate that first high with their second attempt. At this point, we've been going through it so many times, and all of a sudden, it's not only are we trying to take the drug again, but we're flooding the market with that drug, and at some point that ends up killing the patient if we go to a medical analogy. What's your take on the Fed stopping their purchases, going back in stopping buying the mortgage-backed securities, stopping the treasuries, and then aggressively raising rates, theoretically starting in March?
Well, that is exactly my point, is that I don't think they will raise in March, but I think they will conclude their taper in March.
Mm-hmm.
Now, I think the real underlying verbiage in the minutes this week was the reducing the balance sheet.
Yeah.
Now, and what people don't realize is that, it's a business. The Fed is a business, and therefore they're going to have assets and they're going to have liabilities. And outstanding money supply is an actual liability. And of course, we were printing money like crazy, okay? But they started tapering that off, okay? And now that they're saying they want to reduce their balance sheet, what are they going to reduce? Do you think they're going to reduce assets, or are they going to reduce liabilities?
Sure.
That means they're going to tighten the money supply, okay? And the way they're going to do that is going to cause the dollar to start to go up. Drop supply, and with current demand, price is going to go up.
Which is why a lot of us are very bullish on the dollar. Here's the picture of the dollar chart, and you guys can see that it's has not been the best for about the past 3 weeks, kind of a little consolidation. But you're right. I think that that attempt by the Fed to alleviate some of the pressure on them is going to have pressure pushing that dollar up. And remember, when they stop buying these mortgage-backed securities and treasuries, they're shelving money. They're putting money back where they not stole it from, but where they created it from. I wish I could create money like that, but here you have a situation where they're stopping the production of dollars and actually removing dollars from supply, which should have a further upside move. So how does one play that, Mike? If you are standing in the edge of that cliff looking at it, number one, what are the triggers that you're looking for? Meaning, is that criteria that for you say, okay, now I'm convinced? Because at this point, I think I hear you saying, it feels like we're rolling. There's enough argument to roll over, but we haven't done it yet.
That is true. And just in the December meeting with the mastermind community, I said, guys, I feel that it's about time to start, wrapping up our longs, start looking at shorts. And my plan was about the third week of January. And then Monday scared me.
Yeah.
And then Wednesday scared me. But we saw a little bit of a bounce back in tech. Okay. And this is where a high interest rate is really going to hurt. Okay. It's going to help the banks. Okay. They'll make some extra money in all this once they start raising interest rates. And of course, that's going to suppress housing. Mortgage rates will be going up. There's going to be less demand. And come on, the housing market was just fueled by COVID. People wanting to get out of the city and willing to pay almost anything, but they made it cheap. It was
True.
Perfect. Okay. I don't think we're in a housing bubble, but I think that the air is leaking out of the balloon. But it's starting to go dim. The other thing is with a high dollar, I've been a commodities player for a long, long time. It's, you have to go back into the 80s for that. But it's going to put a squelch on our base metals. Steel has already fallen. Aluminum is still pretty solid, but copper is starting to drop. So you think about those things, and then you have to say, well, I'm a stock trader. I'm going to avoid going long Alcoa aluminum or Freeport McMahon for copper, or Rio Tinto in where's that, Brazil?
Yep.
They're all base metal producers, and so I don't trade futures that much anymore, but man, I'd be in there looking for some supply zones.
Yeah, and it's funny you talk about Rio Tinto. I mean, you've seen a great rally over the past 3 weeks on it, but it's right up into a supply zone, and it's been trending down since May of last year. So this is kind of that situation where if you are in that bearish camp, you have to reverse your thinking. If something's in an uptrend, where's the best place to buy? You buy in a pullback into demand. Well, if you're in a downtrend, where's the best play to sell? Well, you're shorting at a rally back up into supply, as Mike's mapping out here. That's not a bad spot for Rio Tinto. What's that?
How about an island reversal?
Yeah. Well, it's tough because at this point, at least from my perspective, it's speculation. And as Brendan, who's not here anymore, I guess we bored Brendan now on the show, but he would say, you never fight the Fed. And at this point, I can't argue with that at all. I mean, you don't fight the Fed, but if the Fed is backing off their balance sheets and they're not buying, then that kind of translates over to, well, you probably may not want to be buying as well.
Well, always follow the money.
Yep.
But, it's institutional play or the Fed. I mean, these are the biggest heavy hitters in the world. So, it's who am I, in there with my little 10 contracts or whatever. So...
when we got some comments in here, so there's comments about inflation, CPI, etc. So Big Eb puts a good one out there, which I guess this is a subjective number, but right now you're looking at about a 6.8% CPI, and Big Eb says when CPI hits 9 to 10%, they will hike. Now remember, I don't think that they could hike, but that'd be insane for them to hike before they finish the tapering, right? Part of the Fed is to, at least what I've seen in my experience in this, is they never really do multiple pieces that impact the markets at the same time. They're going to finish with one, wait a second, see what impact that has, and then they'll go and change another one. So, right now they're tapering. They've doubled their tapering, right? They said they're going to double it going through so they can finish by March, which tells me March will probably get the rate increase. I disagree with Mike. I think that if inflation does continue to move up, I believe we will see a 25 basis point hike in March. But, now that really is telling you that the Fed is scared, right? They shouldn't raise that soon if they're not fearful of what's coming with inflation.
And the Fed shouldn't be afraid. I mean, for gosh sakes, these guys they talk on a monthly basis or a 6-week basis, okay, to the public. But these guys are economists. They're looking down the road a year, 3 years of what it really is going to mean to the United States economy generally, okay? So I'm not going to start an argument with you, but figure we just had a meeting, okay? So we get another one in the middle of or late February, and therefore the next one would be towards the end of March, okay? So that's when the taper ends. I would think probably the May meeting is where you'll see the rate.
It would make more sense. I mean, logically, like I just said, you're kind of waiting for things to pan out and see how the tapering impacts before does them tapering back to zero, does that have a significant impact on the markets? Time will tell. Another thing for people to make note of, and this took me a long time to figure out and at least acknowledge. One of my old mentors on the old floor back in Irvine, California, that Mike was a part of as well, he would tell me, look, when you see these rate cuts or hikes, for that to reach the absolute bottom line of earnings and economic announcements and filter through, now make it into CPI and GDP and all these different economic metrics, it takes between 6 and 9 months for that to happen. So if they start raising March, May, whenever, remember, those rate increases won't really start to impact businesses' financials for probably another 6 to 9 months, maybe even longer. So that's just another thing to keep in the back of your head, that we may not see the impacts of this tapering or rate cuts, or increases in this case, for some time. It takes a while for that stuff to filter through.
That's why I laughed and chuckled when you said they'll tap the brakes and then they'll wait a second. Yeah, it's long, mommies.
Yeah.
And figuring the timing on that puts us right into the, after the September dip, into the Christmas rally.
Mm-hmm.
And the Christmas rally, as you said, may mute the effect. But there's a lot of things going on. I mean, my gosh, I think we have another year at least of COVID. Okay, I hate to say that to everybody, but I think you and your mask are going to get real friendly. But we saw an employment hike in December.
Mm-hmm.
Okay, we get big numbers tomorrow. We get the unemployment numbers and non-farm payroll changes.
Yep.
Okay. And
let's not forget one, Mike. There's one in there. Let's not forget this one. And this is one that I think most people never look at. And I think it actually is starting to become more relevant. Consumer credit is also reported tomorrow. And think about it, as people are hitting hard times and those stimulus checks aren't done, how are they paying for their day-to-day living? It's racking up more credit debt. And if we see that number start to spike, there's actually an expectation of a much bigger a surge up. I think 16.9 billion was the number that we had before, and they're expecting it to be 19.9. So that's a pretty big increase to the tune of almost 20% increase in consumer credit in the past month. So just throwing that one out there too. I think that's something that normally I wouldn't pay attention to, but as we see this economy, quote unquote, back on its feet and looking great, well, that might be driven by consumer credit, and that is not a good thing.
Yeah, $3 billion in a month is the definition of spike.
Drop in the bucket. All right, let's go through a few questions here, Mike. We have the CPI one done. John says, what's up with SLV? You have these traditional inflation hedges, as Chris says. A lot of these inflation hedges seem to be diving with the S&P, right? Normally gold and silver. I'm, again, still long silver. I'll hold it for a while, but, been taking a drubbing over the last two sessions. What's your take on why these are not acting as inflation hedges like they normally do?
Well, once again, because interest rates have jumped so rapidly, okay? So that's, limiting the supply of dollars, and silver and gold are both priced in dollars. So you can get more silver with the same dollar bill, okay? Weaken the dollar, you have to have more dollar bills to buy the same amount of silver. So I think what you're seeing is a knee-jerk reaction. The gap down today in silver just wasn't really warranted. But once again, it's going right back into a demand zone, albeit not the freshest one.
Mm-hmm.
You get down there in the end of September and then in the end of December, okay? But, here, everybody likes you to draw, huh?
We all like to draw.
Yeah, sure.
We're fans of the yellow box.
Yellow box. There we go. So it may not be the freshest, but I expect to see a bounce off of that. And what's going to happen, again, okay, is in 3 weeks, 4 weeks, we'll have another, 3 weeks, we'll have another CPI number.
Yeah.
Okay? And another PPI number, for that matter. So, interestingly enough, the Fed really doesn't look at the CPI and the PPI really hard. They look at the, consumer CPE. What is that? I know the letter.
You mean PCE?
PCE.
Yeah, that's the one the Fed watches, yeah.
So, we'll get another one of those coming out and see what they think. I really think that inflation truly is, our current inflation is truly the result of the stimulus package that we put in last year, the Save America package. Too much money, okay, and created a huge demand. And then the COVID caused all the problems with supply. I really think that's maybe not the only reason, but I think it's the foundation of the inflation that we have now. So I don't think inflation's here to stay, is what I'm saying. I think we'll be, in a year, we'll be back down to 2 to 3.5%.
So you're in the transient inflation category and camp, huh?
I don't think a year and a half is transient.
Yeah, I agree.
Somebody move in. I'd be charging them rent at that point. They're not a visitor.
Yeah, I think it'll. Personally, I think it's going to go longer. Obviously, everything gets back to normal at some point, and when my argument has been, if we look at the interest rates, let me see if I can bring them up for the viewers at home. We've looked at this repeatedly on this show, but you look at the 10-year and kind of put into perspective where we're at. Yeah, we've seen a monster move over the past couple of weeks. You guys can see that one. We actually broke through that 170 mark, which I drew out earlier, saying that's kind of the next step before we jump up to 250, which I think will be on the table. Again, still in an ascending triangle here. But again, if I put this in a monthly, and you look at where we're at, again, the comment would be markets get back to normal. Well, what's normal for the 10-year would certainly not be in the 1% range. To me, normal, looking at the last going all the way back into the 80s, 1980 here, normal. If I go from the peak there at 16% down to the low at pretty much zero here for the 10-year, normal is going to be 4%, 5%, maybe 6%. Now, that type of move up in bonds obviously is going to have a massive impact on the economy with regards to the cost of capital for loans, for businesses, for expansion. And I think until we remove money supply, until we start to take those dollars that we've just created out of thin air and put those back where they came from, I think inflation will be here a bit longer than a year and a half. I think it could be longer. But I just don't see them removing money supply as quickly as they created it.
Well, once again, not as quickly as they created it, okay, because that would cause a vacuum in the economy. Mm-hmm. But again, they've already come out and said, tentatively, we're going to shrink the balance sheet. And as I said earlier, you're going to take off assets or you're going to reduce liabilities. And dollar bills are a liability. So if they're going to have to start shrinking money supply, and that's going to help reduce inflation. But, time will tell. If I had a crystal ball,
yeah, be a completely different story, wouldn't it?
I'd be polishing it every day.
So let's look at. So there's two things. Number one, Big Eb says, so Mike thinks 10% pullback in the S&P from the all-time highs. Would that be a safe assessment?
That's what I'm thinking, yeah.
And if you look at that, yeah, Mike's going to draw it out of here. I was going to draw it too, but if Mike's going to do it, fine.
We're looking at this daily, okay? And again, if we were to just look at where we would go, excuse me, we want a horizontal line. We're talking about right about there, okay? And that's 43.28 was the number I thought I had. Well, we go to the distal, it would be 43.17. Okay.
Yep, that's what I got.
Mathematical one, it would put it at 43.30. Okay, so if I pulled up a calculator, which I did earlier, it comes out to 43.30, 32, something like that. But that's what we're looking at, the potential. Now, obviously, we have these spots in here that it has to overcome. Okay, and round numbers are really pretty good stuff in here. Here's right in this area is basically 4,500.
Yep.
Okay, so it's got to get over those guys. But if it is a true correction and not just profit taking, then I'm looking at this 43.30 area.
Mike, on Monday, I don't even know what day it is, man. I think it was Monday's show. I remember that was the first show we did for the year, which maybe that was Monday. I don't even know what day it is anymore. It was Monday. Man, it's just flying already. I made a forecast, and my thinking is that in 2022, the markets, I believe, are due for a correction. I think 10% is not a problem. That's pretty easy. So my talk track was, let me put the picture up over here for the viewers, and Mike, you can follow along at home if you like, was that we were going to see a much more substantial drop. And I'm thinking, just because of the way that psychology works in the marketplace, my thinking is a 20% drop this year, but... Which it's funny. You look at this chart, Mike. If you drew a 20% drop on your chart, it looks apocalyptic. But when you zoom out and look from where we started in 2009, it's nothing.
Absolutely, yeah.
Right. It looks like nothing. So I think you're going to see that 20% drop just to get things triggered. But I don't think we'll close. I think we're actually going to be down about 15%. So my target for the year end was right around 4,070 for by the end of the year. So just throwing that one out there. See what you think of that.
Well, 4,070 is a good number. Let's have a look at it here.
Margaret, 43.30. Now give us an exact date. Boy, I wish, Margaret. I really wish I could do that. And I agree with Mike as well. You notice that those two red lines, I've had this lower red line there for quite some time, but what was the origin of this last huge run-up? The run-up that we're experiencing today, the origin of that big move was 23.30. Right, so that's a very logical point for this to come back down. But I agree with Mike, that 4,500 mark, which is the bottom of that yellow box that I've got drawn, that's most likely where we're going to head to if we do get more downside pressure. But remember, we're still kissing all-time highs. Yesterday's sell-off, people were freaking out like this at the end. It's like, well, not really. It's just a pullback, man. in the 4 days, that 4-day rally in green that you see there, we went from, I'll put a trend line tool on here. We went in 4 days, we rose 5.89%. And then all of a sudden we fall 3% a day and people think it's the end of the world. We gotta think big picture. All right, so I'll hand it back to you, Mike. I was just throwing my chart, but I'll send you're doing some graphics, and I always like when you draw. So,
okay. Well, one of the other things I wanted to talk about, of course, was the Russell 2000. Okay, the Russells have been acting very peculiar. There's a complete disconnect between them and the other three indices, and after studying it for quite a while and thinking about it, I believe that it's primarily COVID related. Let me demonstrate something here for you. I'm just going to use the old ETF, IWM.
Yep. We like IWM.
Yeah. And go back to the beginning of the year. And so let's just put in a couple vertical lines in here. So we know that everybody was pretty sick.
Sick of staying home. Maybe not necessarily sick, but
so let's start right here with the March, okay? And things started to improve. People were thinking early in the game that this isn't going to last very long, okay? And suddenly there was talk about vaccines and everything else coming out, and it started getting really toppy December. Okay, and unlooked for, it went up in March again. So let's put a marker there and think about where we were in March of 2021. Okay, we were just in front of the Delta wave. Okay, Delta hit us in the summertime, and there's that vertical line, and so that would put us somewhere right in here. And we saw the Russells come back down. But then everybody was getting vaccinated, okay? And kids were going to go back to school. And then we got hit with Omicron, which actually occurred there. Oops, no, a little to the right, Mike. There you go. So that should put us into November, December of this year, just a month or so ago. There. Okay. So all these dips were where the small caps were getting killed, but we had this wonderful run up, just like we did in the S&Ps. And so everybody was going, oh my God, are the small caps going to die? Well, my God, people, how much do you want? It moved from 100 up to 240 in a year?
I want more than that, Mike. It's got to go up more.
120% just isn't enough for some people.
No.
I guess. But once again, we have a whole, not really demand, we'll call it support, okay, right in through here. And you can see how many times it's dipped and bounced. So this is an area of buying if you're into recovery trades, the small caps. Okay, so right around the 210 mark, 209, 210 in that area would be a good place to really start watching for a qualified demand zone in the Russells.
All right. I'm actually I'm over here tinkering. This is what the geeky stuff I do, the viewers. I'm over here playing with Fibonacci timelines because it almost looks like a Fibonacci sequence if you look at what Mike's drawn. That first low to your main one, and it's getting smaller and smaller and smaller. It's just like a reverse fib, so it's kind of interesting. Anyway.
About that.
I'm a geek. That's what I look at numbers. Got kicked in the Omicrons. I like that, Steve. Well, obviously, I agree with you, Mike. I don't think that this COVID will ever be fully done. I do think it's going to be like the common flu, that we're going to have COVID season, and just got to be careful and obviously have your vaccines, have your boosters, have your 37,000 booster shots or whatever Pfizer tells you need to do so they can make money. But I don't think it'll ever go away. I don't know. Viewers, you tell me. Is COVID going to be something that we can look at like polio and go, nah, nobody has this anymore. It's not going to be a non-issue. I don't know. What is the common thought out there? I mean, what do you guys think?
Well, according to, John Hopkins and the Israelis and the CDC, we probably are going to end up with an endemic situation like the common flu.
Yeah.
Okay. But why is the question. And every time I bring this up, I end up in a political argument I don't want to get into.
We want no politics, no politics.
But the point is that if nothing else, you should get vaccinated, at least to take a hit for the team.
Yeah.
Okay. And if we got 25 to 30% of the people who just say, I'm not going to do it because I'm free. Okay. I'm going, you're going to get flu shots, or what do they call it now? Flurona?
I don't know.
It's flu plus the coronavirus.
Oh, nice.
Okay. And that's what you'll be getting Flurona shots the rest of your life.
Yep.
So we eradicated. We eradicated measles, mumps, polio, diphtheria, all through vaccination. The only problem with this one is that it happened so fast. Nobody got used to it. I mean,
right.
God, I was like 5 years old when I got vaccinated for polio. Okay, I had no choice in the matter. My mother marched me down, and I got it.
Yeah, I mean, but is polio's? I'm not. This is not a medical show. But polio's not a virus, is it?
Yes, it is.
Is it?
Polio virus, I believe it is.
Don't know. I'm not going to go in that route. But
the point being is that it doesn't really exist. I mean, it still exists.
Right.
Nowhere near the killer that it was globally.
Exactly. Yeah, and I think you're right. The more that everyone's vaccinated against it, and I am seeing a lot of documentation that people who have it aren't necessarily. You're not spared from COVID. It just means you're less likely, but still people are getting it. But this will be something we just have to deal with as an economy, as a market, and there will be new variants coming up. The good news is that this is not as deadly as it was made out to be at the beginning. When this first hit, I had a friend staying with me from Italy, and we watched Outbreak, which that virus had a 100% fatality rate. Now, that would create some seriously different dynamics than what we have right here. But
we're still killing 1,500 people a day.
Yep.
Okay, so I don't know. I mean, people say, oh, the flu kills 20, 30,000. We're over 820, 100,000.
Yeah. Well, Mike, there's also, and again, this is going to shift it politically, but I don't. There's also, if you look at documentation, there's monetary incentives for hospitals to declare things as COVID. So you're having people who have died from other causes, but because they had COVID when they passed away, it was a COVID-related death, and therefore COVID. So some of those numbers are skewed, but let's move on. So I didn't know it was a virus. Thank you. I didn't know polio was a virus.
I'm on Facebook. I don't have a Facebook or a LinkedIn.
Good for you.
Account. I believe John Hopkins.
Yeah, I'm definitely a fan of science. All right, so how does one capitalize on this? The thinking is commodities. If you have a rising dollar, that means that people can buy more silver or more gold, or specifically commodities. That's been the historical piece. But I saw a message come through earlier. I think it was Lisa. Well, you guys have been pretty active in here. I forget exactly what the comment was, but it was talking about buying financials, because financials do very well when you have a rising rate environment. They make more money. But what's your take on that? Because my belief is if this market does tank, which I think is going to happen, I think it'll happen probably second half of this year will be when we see the big moves down. But if it does happen, it's bringing everything down with it. So would it be best to try to find a buying opportunity or just start shorting stuff?
Well, obviously both. I mean, you do what the market tells you to do. If the market's going down, sell it. Okay, if the market's going up, buy it. Now, how do we know? Well, core strategy gives us some very strong hints about how to find a proper demand zone or proper supply zone and all that. But just by listening, first of all, look, everybody needs to remember that this market is controlled by emotions. Okay, and we always talk about fear and greed, but it's a lot more than that. Okay, I mean, if you took the negative side, you could put in envy and jealousy and anger and fear and all sorts of slices of negative emotion, and the same for the positive: euphoria, happiness, joy, serendipity, all those But when you combine them, we can reduce them to fear and greed. And everybody has a knee-jerk reaction. You know, and put your hand up against a terrarium with a rattlesnake in it. And when he strikes the glass, don't move your hand.
I've done that, by the way.
You do. You cannot keep your hand there.
No.
He's got the first 10 times.
Yeah, that actually scared the living daylights out of me. I had a class in school that was a wildlife class, and they had rattlesnakes in cages. But yeah, it's very crazy.
Anyhow, the point being is that if the market tanks, the banks are going to tank. Okay. Yep. As interest rates rise, the financials are going to make the most money. So that's where you want to be looking for a buying opportunity. If interest rates rise, you want to be looking for selling opportunities in all your commodities and commodity-driven companies, therefore. So if you're a futures trader, you want to get short and be looking for shorts in gold, silver, copper, gasoline, oil. All those guys are going to have some opportunities to get short in. As the dollar rises, okay, housing, we already talked about that a bit. That market's going to start getting tighter and tighter as interest rates and mortgage interest rates go up. So this is the world we live in. But a market tank, a 10%, or even, God not willing, a 20%, I don't think I want that even.
I want it. Bring it on. Bring on the volatility. Bring me some incredibly volatile swings in the market. I'm ready for it.
You don't have enough volatility in your life?
No. We've had so much one direction. It's like the band, right? It's been one direction for the past few years. I want to see some two direction, right? Show me some switch hitting markets that I can go long and short on. Love it.
Oh, where would you find that at, Merlin?
Well, obviously I can go inverted assets like you're bringing up the VIX here. I could go in SDS and QID, but I want to see. Here's my problem, Mike, and others out there, you might be in this category too. I am sick and tired of hearing some jackass who's been trading stocks for 3 months because he started at the beginning of COVID and he's a freaking genius now because he's up 150% of his portfolio. I want to see them eviscerated in a bear market so I can hear them crying all the way to mommy in their basement on how much money they lost. Like, learn how to trade, people. Show me a bear market so we can separate the wheat from the chaff.
Let me tell a quick story here.
Okay.
When Merlin and I were back on the floor in momentum trading, we were at pretty much the tail end of one of the greatest bull markets of all time. And it was just, as Brandon Waddell would say, you buy the dips and sell the rips.
Yep.
And that's all you had to do. And then when 2001 came and the dot-com bubble burst, or we just had too many damn phones, however you like to think of it, it took me about 3 to 4 months to stop buying dips because I was so inured to a bull market. And now we have been in a bull market for coming up on 12 years? 2009 to 19 is 10, and 11 years. 11 years we've been living in a bull market. So when the dip comes, how long will it take everybody to realize it and change the software between their ears?
Yep. Well, and the thing I like to point out, Mike, is that dip that you say that happened in 2000, that was a 50% drop. And that will be, there it is right now, in textbooks around the world as the dot-com bubble. And we had one, the financial crisis, which happened 2007 and 9, which was a 57% drop. And a lot of people tell me that will never happen again. That makes me believe it will. And, a 50% drop from here brings things down substantially and creates buying opportunities. So I can't wait. Bring it on. And
Goldman Sachs was such a master in 2007. Putting together bad mortgage backed debt and then shorting the companies they sold it to.
Oh, gosh. How do you trust it,
Business. That's business, baby.
Yeah. Yep. All right, Mike. Tell me a little bit about your schedule. I know you mentioned you do a lot, kind of with Mastermind Community. You have a typical routine that you do?
Yeah, I'm every Thursday morning at 8 o'clock 8 o'clock California time, Pacific time, and we do an hour to an hour and a half. Depends on the amount of questions coming in and how much coffee I've had. Otherwise, Matt, my schedule's my own. Next week, there'll be some heavy bonding with my kitty cats,
Good.
and Carol's becoming a reverend and is going to marry a couple back east. Can you believe that?
Yeah, I'm ordained as well. I've done 6 weddings so far.
Oh my goodness!
You can call me Father Rothfeld.
Father.
He's called me a lot of things in the past. I don't know if Father's gonna be one of them. All right, Mike. Well, hey, thank you so much. I appreciate it. I'll try to make it more regular. I didn't realize you were kind of just relaxing at home here in SoCal. So we'll try to bring you on once a month. Have some fun with it.
Sounds good, man.
All right, Mike. Thank you so much, and appreciate you coming on.
Bye, everybody.
Everybody, if you want to see Mike, he's pretty much doing Mastermind Community. Maybe we'll get him into the class every now and again, but Mastermind Community is where he's at. You can find out more information by checking out your calendar. He mentioned Thursdays at 8 a.m. Pacific Standard Time. Ooh, mornings, 8 a.m. Ay, ay, ay. Anyway, that was Mike's perspective of standing on the cliff. Standing on the edge of the cliff. I thought that was kind of fun. And again, it's all just opinions. Who knows what's going to happen with these markets. Just be prepared, and hopefully we'll be on the right side of things when it does happen. Yes, and I agree with you. Markets, history does repeat itself, absolutely. And sometimes there's just nothing you can do about it, right? So if this market starts to drop, and the Fed is hand-tied because of monetary constraints or inflation pressures, markets are going to do what they need to do. Robert Breedlove, who is one of the guys I follow with regards to cryptocurrencies. I may have mentioned this story. I think it's just worth repeating. I probably repeated it a few times. But he mentioned that in California, we have such massive fires because we're always trying to put fires out. So when the big one does hit, we can't put them out. They're just so big, and it does way more damage. Whereas if you in Mexico, they just let fires take their course and burn out. But the point there is, by nature doing its thing and naturally occurring in natural fires, etc., it's a lot less systemic damage to the entire ecosystem of let's say, Mexico. With regards to equity markets, if we look at what's happening, they're not letting a market sell off. In this case, a fire burn itself out, right? There should be free markets where the markets do what they're supposed to do, driven by all the different factors, including supply and demand. Well, when you have a situation where the Fed backstops every single drop in the markets and prevents it from going down, at a certain point, when that quote-unquote fire hits, it might be unstoppable. Just like we saw with the California fires and those fires out in Colorado, just a strong wind and all of a sudden creates mass destruction, regardless of what steps you put in place to try to prevent it from happening. Once it goes to where it's going to go, and things reset. So hopefully, with regards to these equity markets, we see some pullback. I think it actually needs to happen to get us back to some semblance of normality. That said, who knows how quick it will happen. I believe it'll be more of a black swan event where it's like you don't really see it coming, and all of a sudden it hits real hard, and in a period of a few weeks it's dropped 20%, and you're left going, oh my gosh, what just happened? And most people aren't going to expect it. At this point, you're looking at some of the short interest. It looks like people are expecting markets to sell off, which really tells me what? Oh, that markets are probably going to keep going higher. Until people get so bullish that it's just unbearable, the markets will keep going up. Right? As soon as everybody gets bullish, that's when things can turn around and they'll catch us by surprise and things come ripping down. So my portfolio for equities has been very light. I'm not taking any real big stabs at this yet because I do think you'll still see it continue to go up until we get more definitive action by the Fed and what they're going to do with regards to rates. We have an idea of what's going to happen, but haven't actually seen anything. All right, here is just some stuff for today, and then I'll get to Big Eb's question comment about GameStop. You might be alerting me to some shorting opportunities tomorrow, buddy. Here is the earnings calendar for today. Notice that most of these have just did great today with regards to earnings, big beats. And I want you to pay attention to the surprise, right? The surprise column means how much did they exceed earnings by? 15% by Constellation Brands, 24% for Walgreens Boots Alliance. Lamb Weston beat it by 51%. You had Helen of Troy's 18%. And then look at every single one of these, except Bed Bath & Beyond, who I don't believe did report. I didn't see their number. Oh, yeah, they did. I don't know why their numbers, they missed big time. was up 7%, but almost everybody was down, which tells you that even though they're having blowout earnings, markets are nervous. And we talked about what's one of the catalysts for this market to move to the south side, and that is corporate earnings, right? If we can no longer sustain these corporate earnings, which I believe the price valuations have driven up those expectations, I think there's a big problem there. So that's one aspect. And then what's going on for tomorrow? Am I concerned about the possible dead cross on Bitcoin? No. Death cross? No. And for those who don't know, death cross is where the 50 crosses below the 200 period moving average, which I may be able to show you here, time permitting, but I got the sniffles all of a sudden. Here's what's cooking for tomorrow's economic calendar. As Mike mentioned, we do have the unemployment rate coming out tomorrow. You also have non-farm employment change. Non-farm employment change, they're expecting a significant jump up in non-farm employment. That might be getting too lofty of an expectation, but previous month was 210,000 new jobs created. They're saying 426. That's over 100% gain in jobs, which obviously would be great for the economy. We'll see how the market absorbs that one, plus this unemployment rate expecting to drop from 4.2 to 4.1%. Now, let's go to one that I think is interesting, and I'm one to be happily bashing GameStop, GME, and let's go and bring this up to a daily. So here's what's happening today. GameStop right now is sitting at 169.50. I guess, Dom, you said they're doing NFTs. I may actually be looking at shorting GameStop again tomorrow, right? The NFT market is in many aspects, I think it's a joke, but in some aspects, there's a lot of value in there. And I think that right now you're dealing with kind of a tulip mania type of thing with regards to NFTs. Once that all subsides, tulips still had value after the tulip mania. It just wasn't at those lofty prices. I think NFTs will have a lot of value, but nowhere near the lofty numbers we've seen, like $50 million for a picture of an ape smoking a cigar on a McDonald's hat. That just sounds stupid to me. So, 168 is where GameStop is at right now, apparently because of NFTs. I'll check that later, but I will be looking to short that one. I think that will probably be a good shorting opportunity. At least I'll buy some shorts that are, buy some puts that are going to be at least 3 months out, because this will most likely give it all back. Crazy. All right, everybody, that's going to do it for me. I noticed that I didn't get a chance to get to the questions that you guys sent in. A bunch of you sent in questions on TraderMerlin@gmail.com. What is a good short for GME? Well, I would be looking at the option chain, seeing where I get the best bang for my buck with regards to premium on buying those options. So tomorrow, what you'll have is the puts will probably be cheaper just because price has shot up so much. So I'll probably go way out of the money. I'll let you know. We'll see if I end up buying some tomorrow. But you could do something crazy. Oops, I didn't know the chart up. You could do something crazy and go out here and buy the 45 puts, which is ridiculous. It's probably going to expire worthless. But again, I'm not going to hold it for 3 months. I just think that what we'll see is a move up here, and then all of a sudden it's going to drift back down and get right back into this downtrend that's been on for the better part of 4 or 5 months now. So maybe 45 is a bit out, but do you go to the 100 puts? You probably get a good price in the 100 puts. Get some not too expensive. And Bitcoin, you guys are asking about Bitcoin. Yeah, I've been talking about 32 in the Crypto Investor Live program. 32 has been that price point. 42 has been the price point that has been of interest. And, we've bounced off that. You can see I've got these lines on here. I've had those on for a while. 42 is the number I was looking for, is kind of the entrance into that zone. But you notice it goes all the way down to 40,000. If you break 40,000 on Bitcoin, I think you're going to check out 30,000 in a hurry. I think you could see a much bigger downside move, just as what it's going to do is trigger a lot of people who are currently leveraged in Bitcoin or buying that 42,000 support level. If that breaks, they're going to get margined out, and all of a sudden you'll see things fall much faster. So there's definitely some more downside potential here for crypto. I did buy some more Bitcoin at 42, so I'm okay. But remember, I have a long-term perspective. Bored Ape NFTs went for 6 cents of an ETH. Now I know, it's crazy. I'm actually, if I had the faculties or the support, I wanted to create a really funny video where it's like how to make $1 million with an NFT, and it's just a simple video. But I'll let you know if I can. I'm writing the script out for that one to see if I can make it work. But all right, that's gonna do it for me. As I mentioned, tomorrow I'm doing just a Q&A show, so you can email me at TraderMerlin@gmail.com or put your comments down below the videos on YouTube. Before we leave, she may have left already. Katut, are you here? Is Katut here? I saw you earlier. Katut's, you were in New York, but I think you might actually be back in Singapore. Are you with us still? Well, hopefully she's here because, we all go through birthdays, and a lot of times I don't know when it's your birthday, but yesterday was Katoot's birthday, and she sent me 2 really nice shirts. I meant to wear one today, but happy birthday, Katoot. I hope you have a fantastic day out there in New York. I think you're still in New York, so happy birthday from myself and everybody here. Glad to have you part of the community. All right, guys, that's going to do it for me. We'll wrap things up. Again, if you have questions, send them in to TraderMerlin@gmail.com. That's the easiest way for you to get questions to me, and I'll answer all those on tomorrow's show. So thank you so much. Have a fantastic evening. And again, if you want to see Mike McMahon, check him out at Online Trading Academy on Thursday mornings at 8 a.m. Pacific time. That's his thing. All right, take care, everybody. I will see you all mañana.